Good evening, friends. Welcome to market scenario in April 2023. Why I decided to conduct this session at this point of time is that after analyzing the technical as well as fundamental data for this week, I have seen there is a total change in the market technical structure as well as also in the fundamentals. So, last week we have seen a sharp rally in the markets from Nifty level of around 16,800. And by looking at all the fundamental and technical parameters, whether this rally is sustainable. So I feel that this rally is sustainable and there is a significant change that has happened in the market. And also, last week, that is last Friday, there was a RBI policy meeting and its decision has come out. So the MPC, that is Monetary Policy Committee meeting, has significant bearing on what is going to happen with respect to the inflation and interest rates and also on the markets. So with all these things in background, I decided to conduct this webinar. Let us start with looking at the market levels. Nifty has closed at 17,599 and it has gained more than 3% for the week. Bank Nifty also has gained around 2.83%. It has staged a rally of around 1,100 points. Cap index has also gained about 1.94%, staged a gain of 578 points. And small cap index has closed at 9,198 with a gain of 346 points, closed with a gain of almost 3.90, that is 4%. So for last week, small cap index has gained about 3.91%. But if you look from the bottom, small cap index has gained about 6% in last 7 8 days. So I had been telling in my last week's review that small cap sector there is a lot of value and we can see a good rally coming up in the small cap sector, which has come true. Now let us look at various sectors and Indavix, which has cooled off, is at 11.79 at present. So if I look at all the parameters, everything looks good except the volatility index, which has cooled off to a very low level. So generally, when the market bottoms out, the volatility level should be higher. But this time, the scenario is a little bit different. So this is one of the factors that we have to keep in mind. Now, if we look at different sectoral performances of last week, almost all the sectors have closed in the green. All the sectors have closed in the green, and realty sector has gained more than 6% in 1 week. So we will examine, and also I will explain to you why there is such a big rally in the realty sector. Infrastructure has gained about 3%, NBFCs and financial services around 3.76%. Private banks have gained about 2.97%. Auto sector, pharma sector, media sector, IT sector all gained about 2 to 3%. And remaining all sectors gained about 1 to 2%. There was a all around buying and all sectors have participated in the rally. So there was a good rally. Now with this, let us look at the charts Nifty chart. And what is so significant in the chart, I will try to explain to you. This is the daily chart of Nifty. If you see my previous week's weekly review, I had told around 16,800 will be the bottom for the market, and we'll see a, from these support levels, we'll see good buying coming back. So I had advised whenever market falls below 17,000, it will be a good buying opportunity. And we have seen that market has spent some time around 16,800 to 17,000. From there, it has staged a very good rally. Now it has already come to around 17,700 levels. Now, why it is this development is so significant is the market has been correcting from 18,800 levels, and we see a lower top and lower bottom structure being made by the chart. So this is a intermediate downtrend in the market. Now what is happening if we look at this? Look at the cursor. See, this is called a inverted shoulder. This is called a inverted head. And the market may make, market has resistance at around 17,800 level. And from here on, whether it will make a uh, another inverted shoulder in this week or after crossing 17,800, this is very difficult to say as of now. But I feel that in the month of April, market will complete its this correction, and it will make a inverted head and shoulder pattern. This pattern is called a trend reversal pattern. The intermediate trend is likely to get reversed in the month of April. And when Nifty closes about 17,800, after completing this, making the inverted head and shoulder, and it closes about 17,800, we'll be completing this intermediate downtrend, and a bullish trend will start. Now, if we look at the long term Nifty chart, what is there in store for us? I will convert this into a weekly chart. If we look at the weekly chart, market crashed in 2020 due to coronavirus problem, and the market corrected, or Nifty corrected from 12,400 levels to 7,600 levels. From 7,600 level, we have seen a non-stop rally 18,600 levels, and from there, that from October 21, the market has been in a correction or consolidation type of scenario. So this correction is now around 1.5 year, from October 2021, October 2022, 1 year. Now we are in April. So it is completing almost 1.5 year. And I have done a study on the historicals of the market. If we look at that, from 2000 to 2022, in last 22 years, Indian market has never been in a correction phase for more than 1.5 year. The big corrections have happened, small corrections have happened, but even the big correction lasted for only 1.5 year. That is around 17 to 18 months. After that, the bullish trend resumes. Let us look at longer term picture of the market and try to understand. See, this is February 2000. Nifty was at 1,800. From there, it corrected. It came to 1,000 levels. And this correction, if you see, this lasted till 20th 6 2003. So the correction period is around 18 months. Market has given a big rally from around 1120 to 6000 Nifty levels. This rally was the one of the biggest rally from 2003. It lasted till 2008. In between, there were small corrections, but these corrections were not even 1 year. They were for 6 months, 8 months, small corrections. In 2008, there was global financial crisis, and there was a big correction. From 6,000 level, market corrected to Nifty corrected to 2,600 level from 6,000. And how long the correction lasted? The correction started in January 2008, and by 2009 June, by 2009 the correction got over, and we have seen the market rally started. So this rally also lasted for about 1.5 year. And after that, there was a small correction in 2010, and this correction lasted July 2012. So yeah, this period is also again 1.5 year period. After that, we have seen market rallying in 2015. Again, there was a correction. This correction is quite similar to what we have seen now, because inflation was going up in US and in India those days, and the interest rates were being raised in India as well as in US during this 2015 to 2016 period. Janet Yellen was the US Fed chairman those days. So here also, due to this, now also what has happened is that last 1 year the inflation has gone up. The interest rates are being raised in India and US. That is why the situation is very similar in 2015 and in now, so last 1 year. This correction also lasted for about 1.5 year. Then by 2016, the rally has resumed. And this COVID crash was very sudden, and then sudden rally. There is no time gap. Now, the present correction after COVID, that is started in 2021. This is also now completed around 1.5 years. And on a short term structure, that is on a daily chart, we have seen that there is a intermediate trend reversal. So this correction is coming to an end. And on a longer term, the market has to cross 18,600. If it crosses 18,600, this entire formation, that is the bull run from the low of the COVID correction up to 18,600, and then last 1.5 year correction and consolidation is called the flag of the uh, cloth of the flag. This entire structure is called a flag, and this is called the cloth of the flag. When Nifty closes above 18,600, the chart structure indicates that we will be starting a next big bull run, and this can take Nifty to 28 to 30,000 levels. So this is a long-term chart. It is a weekly chart, and how long it will take to achieve the target? It may take 3 to 4 years. So, and we are also knowing that Indian economy is going to become the third largest. Will cross $5 trillion dollars GDP. So when this is going to coincide with the market rally, Nifty rally. So if our economy grows and we cross 5 or 6 trillion GDP, that is the time the market will be also rallying and Nifty will be at 28,000 to 30,000 level. This is what is indicated on the long-term chart. So as per the this long-term chart pattern, this entire rally from 7,600 to 100 to 18,600. This is called the pole of the flag, and this last 1.5 year correction is called the flag of the uh, cloth of the flag. And this chart structure has a target 18,600 plus another 12,000. That is 18,600 minus 7,500. This is the length of the pole. So if we add these up, the target will be around 28,000 to 30,000 on Nifty. And accordingly, the Sensex also will go from present say 60,000 level to crossing 1,20,000 levels. So this is a long-term target for Nifty, which is very well coinciding with our aspirations of India crossing 5 to 6 trillion dollars GDP growth and also becoming the third largest economy in the world. So this is the thing I noticed during analyzing the charts. That is why I decided to conduct this webinar. Now let us look at some of the fundamentals. The most important thing that happened last week was the RBI Monetary Policy Committee meeting. Everyone was expecting that RBI will raise the interest rate by around 25 basis points. But RBI surprised the street and all the analysts, and they maintained repo rate at 6.5, and there is no hike. So this has given very good signal to the market that inflation is peaking out and also interest rate is not going to go up further. This is what is the signaling done by RBI. But RBI governor has said that this time we have not raised the interest rate and we are keeping a watch on inflation. If required, we may raise interest rate. We all know that RBI has raised the interest rates for last 1 year successively. Every 2 months there is a RBI Monetary Policy Committee meeting, and last 6 meetings they have raised interest rates successively. This is the first time they have not raised the rates; they have taken a pause. So this gives a very good signal to the markets. So the inflation in India had touched almost 8.9, and after that it has started coming down. The RBI has maintained that the inflation will be controlled and it will be at around 5.2 by the end of next financial year, FY24. And they have forecasted GDP growth of around 7% for the current financial year, that is the financial year ended in March. And for this financial year, that is FY24, they have told that the GDP growth will be 6.5%. But this is on a larger base. So 6.5% is a significant GDP growth for FY24. Markets have welcomed RBI policy and closed higher. Rate sensitive sectors. Which are the rate sensitive sectors? Realty, because the EMI for housing, if the interest rates go high, people will be paying higher EMIs. So demand for housing loans and real estate, that is the housing, will be less. So when interest rate goes up, real estate sector is very badly affected. Similarly, banking and financials, they are also dependent on the interest rates. Automobiles, discretionary consumptions like fridge, ACs, coolers. So these are all discretionary consumptions. They are also affected. They are called rate sensitives. So the rate sensitive sectors are realty, housing finance companies, NBFCs, banks, automobile companies, and to some extent even pharma companies. So these are all called rate sensitive sectors. When RBI has passed the rate hike, we have seen rally in all these sectors. RBI governor has told that we have a very good forex reserves of 578 billion, and he has told during the policy statement that forex reserves condition is quite stable and it is sufficient to take care of any ups and downs in the global markets. INR USD rate is at 81.83 and dollar index is at 102.13. What had happened after the Ukraine war last year? There was a huge demand for dollars. So dollar index went up from 102 to 114 in last 1 year, and from 114 it has corrected to 102. In the same period, rupee against the dollar went up from around 75, 76 level to 83. When dollar index was at 114, rupee depreciated to 83.2. And from there now, the demand for dollars have come down. Dollar index has come down to 102 from 114. Rupee has come down from 83.3 to 81.83. So RBI had sold about 100 billion US dollars to stabilize rupee. So that has helped the rupee to remain stable for about last 6 months. So we have seen recently that some of the banks in US and Europe, banks like Silicon Valley Bank, Signature Bank, Silvergate Financial in US, and Credit Suisse in Europe, that is a Swiss based bank, they have gone bankrupt. They had closed down. So when this such crisis is there, money is moving from US dollars to gold. We have seen rally in gold prices from around 50,000 level to gold prices come to 61,000 level. So globally, money has moved from US dollar to gold when this banking crisis has hit in last 2 months. That is why we have seen the dollar index coming from down from 114 to 102, and gold price moving from around 50,000 to 61,000. Similarly, the Indian rupee from 83.2 to 81.83. This is how the overall global currencies have moved. What is good for India is the PMI manufacturing index for March 23 has come at 55.3 and PMI services index has come at 57.8. So whenever PMI index is around 50, it indicates that there is expansion in the manufacturing activity and also in the services industry. So the PMI manufacturing index and services index comparing to month of February, they are slightly less, but still they are above 55, which is indicating a good growth in the Indian economy. So when there is growth in economy, companies' business expands, and when their business expands, their profit will expand, the share prices will go. That is good for the market. That is what we are seeing. Because of all these leading indicators, market is got the confidence and it has started moving up. Another good thing is direct tax collection for FY23 has gone up by 17%. GST collections have, have been above 1.6, 1.5 lakh crore for last 6 months, and for the month of March it is at 1.6 lakh crore. So when industries are producing more, when service sector industries are growing, they will have to pay higher GSTs on their production. So that is why we are seeing GST collection is going up, which indicates that our economy is doing well and it is expanding. Last week there was a meeting of oil producing nations, that is OPEC. They decided to cut the oil production because they want the oil prices to go up. Their economies are based on the crude price. They are the crude price producing countries. So they decided to price cut. With that, the crude oil price has gone up from around 78, 79 to 86, and it has closed at 84.9. So this is one slightly difficult sector for India. Whenever crude price goes up sharply, it adversely affects because we are importing almost 80% of our crude requirements. So when crude prices go up, our import bills go up, and when import bills go up, our fiscal deficit will be adversely affected. Our trade balance will be adversely affected. That is why higher crude price is a risk factor which we need to watch. FIIs have returned to Indian market. Now we all know that FIIs have been selling for almost last 1 year, and due to their selling, our market is under pressure. Whereas the domestic institutional investors, that is DIIs, mainly mutual funds, they have been buying into the Indian markets every month. This is because around 12,000 crore per month is coming into the equity SIPs, and these mutual funds are getting SIPs from the retail investors, and they are investing that money into the market. So Indian market has been able to absorb selling by FIIs due to the continuous buying by the DIIs. But what has changed in the month of March and now in the month of April is that for the month of March, FIIs were net buyers. They have stopped selling and they have started buying. And in the month of April so far, in 2 3 days only, they have bought more than 1,100 crores. And DIIs continue to buy. So this is good for the markets. Now the result season is coming. That is March quarter. January to March quarter results will be announced in the second week of April. Many banks have given, and other companies also have given their business updates. And business updates are good. Banks have reported credit growth in the range of 12 to 15%. SBI has reported a credit growth of 14%. HDFC Bank has reported a credit growth of around 17%. And many other companies are reporting their business update. The tax collections have gone up. If you see the tax collection in 2023, that is corporate tax as well as income tax, the direct tax collections are continuously going up. So it has gone up by around 17% for the last financial year. Indirect tax, that is GST collection, is also uh, continuously going up. And if you look at GST collections, it is, you can look at these columns which are in blue color. So we are continuously maintaining the GST collections around 1.5 lakh crore, which is indicating that the industrial activity and commercial activity in the economy is very stable and increasing. So this should give a confidence to the markets. PMI index, as I had explained, this dotted line indicates the 50 level. Whenever it is above 50 level, the economy is in the expansion mode. So mainly our PMI manufacturing has remained above 50 level, and PMI services, if you see, for a few months during lockdown, there was no people were sitting at home and there was no any service activity. Tourism, hotel, trains, all these things were closed for about 1 year. That is why PMI services index was in the negative. But now it has picked up, and now PMI manufacturing index is at around 57. So the service industry from the lower levels has grown very fast last 1 year. Now let us look at the pickup in housing demand. So it indicates that housing demand has been steadily picking up in India, and housing price index is also going up. If you look at the screen, the housing price index has also started going up. And also there is a report that the inventory levels in the realty sector, that is the ready houses, unsold ready houses, has come down, and that is also showing that the realty sector is going to be seeing a good time in coming months. And also RBI has paused the rates. All these put together, we have seen good rally in the realty sector. I had shown you that realty sector has seen a rally of 6%. So this rally is likely to continue. With this, shall we invest in real estate companies? I am not very good fan of real estate sector. Inherently, we see that the corporate governance is not very good in real estate sector, because we all know the involvement of black money or cash component in the real estate sector. And how to play this sector is that we should look at housing building material sector, like cement, steel, ceramics, paint, then housing finance companies. So these are some sectors we can look at playing in the realty sector. It is like a automobile ancillary industry. So ancillary industries in real estate sector, there are very good companies. If you want to really get into real estate companies, you should look for big corporates like Godrej Properties or something like that. Next is credit growth in the banks. I had discussed that banks have reported credit growth. If you look at this pink color line, the credit growth has started picking up. But the mainly credit growth is coming from the government spending. The private sector credit growth is yet to pick up. So there is a gap in credit to GDP ratio. So this gap we can see. So this gap has to be filled. This will get filled mainly when private sector starts investing in capex. So there is room for further credit growth. So, and this credit growth is going to come because we are seeing expansion and demand in different sectors as per the business updates. So this credit growth will come, and that is will be very good for the economy and also for the markets. Banking and financial sector is in good health. A lot of banks in US and Europe, they have had to close. They collapsed in last 2 months. But in India, thanks to several steps that has been taken by RBI and the banking sector in last 6 years, the Indian banking sector is in very good health. The NPS of banking sectors is coming down. Overall loan portfolio of banking sector and non-performing asset ratio is coming down. This is a blue line you can see. So NPS in the banks have come down, and there is credit growth in the banks. They are able to lend. They are Banks are well capitalized at this point of time, including PSU banks. So good time is going to come for the banking sector. And we have seen already even PSU banks posting very good financial results for last 2 3 quarters, and they are on a growth path. So it is good time to invest in banking and financial sector for next 3 4 years. So relative stability of Indian rupee. We are saying that Indian rupee from about 75 76 level were depreciated to 83 levels. If you look at the overall global scenario, Indian currency has been quite stable comparing to all other currencies. All other currencies, there is a huge fluctuation on the positive side and negative side. Whereas Indian currency comparatively is quite stable. The volatility has not been as high as in the currencies of other countries. So rupee is stable, and that stable rupee helps importers and exporters and also the industries to manage their business better. So Indian rupee volatility has been quite less compared to the global scenario. So RBI has played a major role in stabilizing the Indian rupee. They had to sell about $100 billion of 100 billion US dollars in the market to stabilize the rupee. With all this, a stable rupee helps the economy and markets also. Inflation went up after COVID, and all prices started rising. Inflation started rising, and that was further aggravated by the Russia-Ukraine war. There was disruption of global supply chain. The exports coming from both Ukraine and Russia, they were disrupted. So because of that, the commodity prices shot up, and now, more or less, it is 1 year after the Ukraine war. All the economies they have been able to absorb the shocks of the Ukraine war, and the commodity prices have started coming down. Due to high inflation, the demand in US and Europe and other developed economies has come down. They are fearing there will be a recession in those economies. That is the reason that demand slowdown come down, and also the supply chain disruption, which was all of a sudden caused by the Russia-Ukraine war, also by now has stabilized. So, due to these two reasons, the commodity prices are coming down. The lower commodity prices will have a better impact on the profits of the companies, because the cost pressure on them, input cost pressure on the companies will come down, and when input cost pressure comes down, their margins will expand, their profitability will go up. So market has sensed all these things. That is why we have seen that market has started rallying. See, oil prices have a high impact on Indian economy and stock markets. So oil prices last week had suddenly jumped due to the production cut by OPEC countries. But overall, if you look at, due to the Ukraine war, oil price went up by around 80 $85 per barrel to 118. It touched a high of 118, and from there it has come down to around 78 79. and due to the OPEC production cut last week, it has jumped to 86 and now it is at around 84. So higher oil price will be a risk factor for Indian economy as we import high crude prices. So this needs to be watched. RBI expect the inflation to cool down in the coming quarters. I had explained earlier. RBI is expecting that the inflation will be at 5.2 by Q4 of 2023-24. So CPI inflation also they are expecting to come down to at around 4.5 levels and overall inflation at 5.2. So that is the reason RBI has not raised interest rate this time. So we need to keep a watch on the inflation and the interest rates. So why market is so happy with this is that now we are almost at the peak of the inflation and the interest rate hike cycle. Now it may take about another 1 year for the inflation and interest rates to stabilize. And when the inflation stabilizes and the inflation starts cooling off, RBI will start cutting the rates. When the RBI starts cutting rates, that time markets will rally. So we are all set for a good rally. That is what the long-term chart, weekly chart of Nifty I had indicated. When Nifty crosses 18,600, that is still time. This is what will coincide with the RBI rate cut cycle, which may be another 6 months to 1 year away. So that time onwards, then when there will be a rate cut cycle, during that cycle we'll see a huge rally, and that will be coinciding with the general election of 2024. So during the election year, there will be a lot of spending by political parties. This will see a heightened economic activity in the economy. Uh, if we look at the past history, so there will be a pre-election rally in the markets because the spending in the economy goes up. See, we have also worried that the Indian markets have corrected in last 1 year. SIP returns are negative. So people's portfolio is in the red. People are sitting with the losses. So we are all not happy with that. But if you look at the overall global scenario, our markets has done very well. As per this report, if you look at the other markets volatility and look at the Indian market volatility, our correction has been very, very nominal. The volatility in Indian markets, I was telling you that India VIX is at a very low level. That is a India VIX is the volatility indicator. So the same thing is if we can see on this chart graph. So, comparing to the global scenario, Indian markets have done very well in last 18 months. We have seen the least volatility in the Indian markets. So good times are going to come in the markets. With all these things, so what the investors should do? They should invest through mutual funds. The common investors who cannot understand the markets should invest through mutual funds. They should continue with their SIP investments. They should not try to invest in stocks directly. Those people who are interested in investing in stocks directly, they should really understand the markets. So I can help you to get the cutting edge knowledge. Lot of study, a lot of monitoring is required if you want to directly invest in the stocks and make money. Otherwise, you should invest through mutual funds. You will make good return there also. So, if you are interested in learning, I conduct technical analysis workshop. This is about 16 to 18 hours workshop. So, either it will be 2 full days workshop, or we can do it in over a week or 10 days period. Then fundamental analysis is another module. This is again another 16 to 18 hours module. So this also can be done in 2 full days workshop or 8 to 10 days period of 2 to 3 hour sessions. Then future and options training is there. This is a 3 full days workshop or around 24, 25 hours of workshop. So for normal equity investors, technical analysis and fundamental analysis should be sufficient. Future and options and option pricing, trading strategies, this is all for the traders. So my this course material I have submitted to SEBI. It is reviewed by the SEBI and it is okayed by them. So I don't teach on speculation. I will not assure any guarantees written from the markets. It is subjected to risk. So, but we can learn how to manage those risks. That is what is taught in the during the course. There are different strategies of managing portfolios, managing risks, and all these things. So, a lot of people look at many videos on YouTube and all these things, and then they end up making losses. So, if you want to really learn the right way of investing or trading, you should take the workshop. Right now, I don't have any dates or program for this workshop. When I get inquiry from people, when there are 8 to 10 participants, I conduct these workshops. If you are interested in these workshops, you can get in touch with me. So I really don't sell and do the workshop on a commercial scale. I am happy to teach the right knowledge to the interested people only. So those interested people can get in touch with me. So this is all what I planned. So at the end, why right knowledge is required, this is a little bit of humor at the end. So stock market is like an elephant. People by looking at TV channels or by looking at some YouTube videos, they think that they have understood the market and they venture into the market. So you need to get a overall view of the elephant. Otherwise, you know, like the story of 5 blind people exploring the elephant. So what is the caution is do not go to the market blindly. Otherwise, you will end up, somebody says market is dangerous. Somebody says, I have lost money. Somebody says, I have doubled my money in 1 week. These are all like blind people touching the elephant at different places. So if you want to learn market in a very systematic way, the right way, you can get in touch with me and we will plan or schedule a workshop. So this is all what I wanted to cover in this webinar. Thanks for sparing your time. Wish you all the best. So if you have any questions, you can ask those questions. Thank you.